Hello and welcome to the business interview. I'm Markus Karlsson. It's been billed a moral failure, a damaging scam, and the symptom of a broken and poisonous banking system. The critics haven't been kind after British bank Barclays was fined for manipulating interbank lending rates. In this programme, we're discussing the scandal with one of the most respected voices in the City of London. Martin Wolf is the chief economics commentator at the Financial Times, and he joins us now from that newspaper's offices in the British capital. Thanks very much indeed for speaking to us.
It's a pleasure.
Now, to the average man in the street, interbank lending rates, they're virtually unknown, and it's difficult to really get a grasp of this scandal. Why, in your mind, has this scandal touched a raw nerve?
And before I answer, it's worth stressing this is not over, because it's clear that our regulator, the Financial Services Authority, and other global authorities are looking at a lot of other banks, because this was about the interbank market. So the whole range of major banks are involved in this index of the price at which they lend to one another. And it may well turn out that there are other institutions involved. So it may be much more significant even than it now appears. Why is it important? Because the rates which are reported here on lending among banks in various currencies, including, above all, the dollar, it sets a benchmark for very many contracts around the world, determines, particularly for floating rate transactions in which interest rates change over time. It often sets the benchmark. So an enormous volume of transactions are set in relationship to this index of the rate at which banks lend to one another. And of course, if it's misreported deliberately, it can lead to very significant losses or gains, of course, for other people who are completely innocent bystanders.
Now, George Osborne, the British Chancellor, he said that the former British Labour government was clearly involved in pressing Barclays, putting pressure on Barclays to lower its rates, or the rate that it was reporting. What's your sense of that? Do you think that this could go as far as that or as high as that?
This is a very complicated aspect of this story. And this is my understanding as it is now, and it may well change. It's clear that from the agreement, the fine, that Barclays misreported information relating to LIBOR over a very long period, which had nothing whatsoever to do with the crisis. There is, in addition, or I would say separately, an allegation which essentially originated out of the reported conversation between Bob Diamond, the former chief executive of Barclays, and Paul Tucker, a deputy governor of the Bank of England responsible for financial stability, in which it is alleged Mr. Tucker took up the question on behalf of unspecified people in Whitehall, in government, took up the question of why Barclays was reporting such high rates in a very specific period, October 2008, which was, of course, the height of the crisis. So it's not about the whole period for which Barclays was held responsible, this very specific period. In that period, everybody knew that the London interbank market was essentially frozen, that a lot of the rates that were being reported were mythical, because, in fact, as Mr. Diamond pointed out in his testimony before the parliamentary committee, they were almost making it up because nothing was happening. Barclays was announcing rates at which it was borrowing, and they turned out to be very high. And the worry, it is suggested, from the Bank of England's point of view and the authorities, was that this was suggesting that Barclays was itself going to need a rescue, and therefore they should consider whether they were reporting in a sensible way. And then it is suggested, Mr. Diamond pointed this out to a subordinate, and the subordinate then followed this up by lowballing the rates. But it's important to be clear, it's a very complicated story. This is about what was done in the height of the crisis when it's absolutely clear, at least to me, that the LIBOR rates were very, very misleading, and possibly they shouldn't have been even reporting them. I don't know. That's a big policy question. But it's a very big issue. What was done then is a big issue, but it is important to remember that in the height of the crisis, a lot of the authorities around the world were involved in propping up the banking system in all sorts of ways. And I suspect that we'll see when Mr. Tucker gives his testimony, it will turn out to be part of that and perhaps even quite understandable.
I just want to put this scandal more into context. To the general public, this is probably yet another banking scandal in a string of them. Do you think that this one, though, is more damaging for the industry itself than the previous scandals, as I say?
There has been so many different ones. It's just been a long slew of them, which is, of course, what you tend to expect after a financial crisis. I think what's important here, at least in the UK case, we've had quite a number of scandals in which clear banks ripped off the customer. There are very technical aspects to these various scandals, but it's very clear. In this case, banks were misleading the market. And so they were introducing a very large distortion in the market by misreporting the prices at which they were transacting with one another. You could argue that this is sort of less costly directly to customers, in that sense less exploitative, but it gets to the integrity of markets in a more fundamental way. And it clearly gets to the question of how with the investment banking sides of the business, because this is what this is really about, going about their business. So I wouldn't say, it's not clear to me that it's worse or better, if you like, than other scandals, but it's different, and it raises questions about the conduct of businesses in a sort of core aspect of the market and the reporting of what they're doing in the market, which are, I think, new.
On the back of that, you were part of the Independent Commission on Banking in the UK last year, which made recommendations on how to regulate the banking sector. Is there a real cultural problem in the City of London and in the banking industry as a whole? What do you say to that?
It's a very big question, and it wasn't directly one it was easy for us to assess because we're not the regulators. We weren't regulators. We couldn't follow up what they were doing on a day-by-day basis. Our approach was to take the view there is a problem about the universal banks. They were in our view and are in our view fundamentally unmanageable. I think that is confirmed by this testimony from Mr. Diamond, who suggested he didn't know what was going on, which was very striking in the bit of the bank he controlled. And we were very concerned about the risks that the investment banking posed for retail banking. So we were asked to look at and recommended a structural split between the retail banking, which will be ring-fenced in a very profound way from investment banking. And we thought, if we did that, that the cost of funding to investment banking would rise and the cost of capital would rise and the investment banking business would shrink to a more reasonable scale. So I tend to think that what we have recommended is certainly consistent with our subsequent lessons, but they weren't directly aimed at this sort of thing. Now, let me just add one point. It does seem to me plausible, though I couldn't give you any solid empirical evidence, it does seem to me plausible that the culture of investment banking and particular trading, which was the area where the banks were making so much money, as it were, took over the whole banking industry, particularly in these big universal banks, and to some extent, perhaps a significant extent, tainted the whole industry. And that is an argument, I wouldn't want to overstress it, but it is an argument for making retail banking and investment banking much more separate than they were in the past. And more broadly, of course, enormous amounts of money were made by the institutions and by the traders. And I think it is a plausible argument that being able to make so much money so easily had very damaging effects on people's sense of what was decent and reasonable. And that is emerging.
We don't have a lot of time left, but I wanted to switch topic as well to the Eurozone debt crisis. The reaction has been upbeat since the last European Union summit. Do you think that we've definitely turned a corner now in the crisis, seeing the market reaction on the back of it?
I think that's going too far. I'm absolutely convinced there are going to be worse moments in front of us. There is very big problems left in adjustment to competitiveness and in managing the debt of some very important countries. Spain is still in very severe crisis. It's not clear quite how it's going to evolve in Italy. There are many political and economic problems. However, that said, it does seem to me that quite particularly on the issue of banking and the step towards a banking union, and therefore separating the banks and their vulnerability from the sovereigns with which they're so closely linked, they did make progress on that, and it could, not definitely, but it could prove to be very important in making the crisis, however bad it gets in future, at least manageable.
This week, we've seen the European Central Bank lowering its benchmark interest rate once again to 0.75%. Is that a good idea? Was that a good idea?
Yes. I don't think it'll make a dramatic difference, but I think the ECB's rates in this current terrible context were clearly too high. I think the ECB has to be much more aggressive than this. I think it's been far too lax in, if you like, complacent in allowing what seems to me likely to be a very serious recession in the Eurozone to emerge over the next year or so. And if there's a very serious recession in the Eurozone as a whole, if I'm right on that, then the prospects for the weaker economies are really grim. They need growth in the Eurozone if they're to adjust and grow in their adjustment. And so I think the ECB was really very remiss in allowing this gathering recession to emerge. I would like them to do some version of quantitative easing. I would like them to intervene in bond markets. But I think this cut is the least they can do on their own criteria. Monetary growth in the Eurozone is stagnant. They had to do something, and I hope they'll do more.
All right, Martin Wolf, as always, very interesting to get your thoughts. That was Martin Wolf from the Financial Times speaking to us there. And with that, we're going to wrap up the program. Thanks for watching.